Cash, it's something we can all relate to, something we can all recognise, and it's an essential ingredient to keep our business going. In today's video, I'm going to focus on cash as a basis for measuring profits and using that to go into your tax return. Measuring profits can be done in one of two ways, which are acceptable by our friends at the tax office, HMRC, and is also used quite often by businesses to measure how they're performing. In this video though, I'm going to be focused on the cash basis of measuring profits, who it applies to, some of its advantages and some of its drawbacks. And later on during this video, I'm going to walk you through an illustration showing you the differences between the two methods. Hi folks, welcome to another weekly episode on I Hate Numbers. This is the channel that has got a mission to improve your financial awareness, help you make more money, help you have the business that you desire, and help you win more battles than you lose with what goes on between your ears. My name is Mahmood. I'm an accountant, an educator, and proud author of the book, I Hate Numbers. Let's crack on with the video. First of all, what do we mean by cash? And cash, as the name implies, is what goes through your bank account, the money that comes in from the work that you've done, from the goods that you've sold, and the money that goes out. It's also the physical cash that you collect from your customers. So measuring it and identifying it is a bit more straightforward. So in theory, it's a simpler way of measuring the value of your turnover and thereby the value of your profits. Its calculation is straightforward. You add up all the cash you've received, you deduct all the cash that you paid out for your business expenses. The difference is your cash profit. Now there are certain businesses that are not able to use the cash basis, and typically they are. If you're a Lloyd's underwriter, for example, you can't use this method. If you are a minister of religion, you can't use this method. If your turnover is over £150,000 from all the businesses that you run, you can't use it. If you're a limited company, it doesn't apply to you. There are situations though where it's not advisable to use the cash basis. So if your business is relatively straightforward, it's straight ins and outs, you don't have any outstanding customer invoices, you don't have any inventory, you don't have any major fluctuations, then it's a good method to use. It's simple certainly, but it has its drawbacks. And the drawbacks are as follows. First of all, when it comes to losses, and unfortunately at some point in your business life, you will incur losses. Fingers crossed that you don't, but it's likely to happen. If you do make losses in your business as a sole trader, then there are ways to mitigate and reduce the impact on that loss. If you use the cash basis, carrying back that loss to a prior year, using what's called sideways relief. So you may have additional income like PAYE. If you use the cash basis, you can't use those losses to help reduce the income from other sources. Also, lenders may not be very comfortable with that method of measuring your profits. If you're looking to raise finance, if you're looking to get a mortgage, the cash basis may not be acceptable by that lender because they don't accept that that is a true measure of underlying profit. If you've got interest charges, loan charges in excess of £500 a year, you may find that to be a drawback as well. My personal preferences, all the clients that we've looked at over the last 28 years, we've always used traditional accounting because it also gives a more insightful and accurate picture of what's going on in your business. Other reasons why it may be a drawback is if you are, for example, an arts freelancer and you're receiving grants, whether it's from Arts Council, local authorities, then you will be measured on when that grant is received. Traditional accounting rules do not apply here. So when it comes to looking at the cash basis versus the traditional basis, again, the choice is yours. If it's simple, if it's straightforward, you're doing the accounts yourself, the tax return yourself, it's a nice, easy methodology to use. Deduct the cost of capital assets as and when you incur them. So folks, that's the overview, that's the outline. Follow me while we walk through an illustration of what that actually looks like. In this illustration, I'm going to be comparing and contrasting the two methods of measuring profits. These profits that we're measuring will ultimately go into the tax return, but the illustration also serves as a reference point for how we prepare accounts on an ongoing basis and how we prepare accounts in the future. Now, the two methods we're going to be comparing and contrasting are the traditional method of measuring profits, what we're going to call traditional accounting, and this measures profit based on not when we physically receive and pay out cash, but when the actual activity occurs, and that activity is reference to turnover and the incurring of expenses. Our fictional business owner in this example is a decorator. During the course of the year, they undertake decorating work to the tune of £40,000. The value of the materials they acquired during the course of the year is £10,000, and during the course of the year they've got other business expenses of £5,000. So let's see what the two measures of profit actually look like. Now, under traditional accounting, there is likely to be adjustments for invoices that are outstanding when we move on to cash. So let's chuck a few numbers in and see what we get. Now, the value of the work was £40,000. Now, our particular business owner is doing this work and he's allowing his customers time to pay for their bills. And let's assume at the end of his first year, there's £3,000 outstanding. So that's the money he's not yet collected for his customers for that work that he's done during the course of the year, and he will be paid for that in the following year. Now, under a cash basis measure, the value of the turnover is 37. Under a traditional method, it's 40. Now let's have a look at the cost of materials that he's had to buy, the paints, the wallpaper. Let's assume the value is £10,000. It's £10,000. Under traditional, again, we look at the value of those supplies, whether they've been physically paid to the supplier or not. Because we're looking at the first year, there's no outstanding invoices from last year. And let's assume the outstanding bills to the supplier for paint, wallpaper is £2,000. Under a cash basis, the value of those purchases are 8. Under traditional, the value are 10. Which one do we think is going to show a higher profit? Now, there are other costs that we mentioned earlier, and let's assume that comes to the tune of £5,000. In this example, we're assuming there's no outstanding bills for any of the travel costs. Accountants' fees have been paid as we've gone through. So under traditional, the value of the profit that will go into their tax return is 25, and under a cash basis, it's 24,000. I'd like to extend this now to have a look to see what's going to happen in year 2. Bear in mind, any invoices that have been outstanding from customers or to suppliers will be honoured in the following year. And certainly that's our wish. So let's fast forward to year 2. Let's assume, for the purposes of comparison, that we have got the same level of turnover and the same level of cost, the same value that's being carried out. Now we come to year 2. Let's assume the same level of activity financially. So they've done the same level of work, they've bought the same amount of materials. We assume prices have been frozen. So when we come to year 2, we are going to assume that effectively the same level of work that's being carried out has the same level of work, they're charging the same fee, and the suppliers' prices haven't changed, and the other running costs are as they were in year 1. So £40,000 is the value of the work. Now, under traditional accounting methods, the turnover doesn't change for the outstanding invoices from the previous year. We measure it based on the activities undertaken, and that's 40,000. Now, when it comes to cash basis, however, we've got to take into account what's physically being paid out. Let's assume, in this example, that the trader has no outstanding invoices. Now, when we come to year 2, the previous invoices that are outstanding from our customers and to our suppliers will be relevant now when it comes to measuring profit under a cash basis. Because what's going to happen, whatever we receive from the work we've done in year 2, plus the receipts from the outstanding customer invoices from year 1 will be taken into account to work out our cash turnover. So turnover 40,000. We had the outstanding invoices from the previous year, the value of 3,000. We'll assume nothing outstanding, by the way, for this particular trader. Therefore, the cash received is the 40 plus the invoices of 3. That gives us 43,000. Material purchases have been the same, 10,000. Under cash accounting, we didn't include the 2,000 that was owing from the previous year. That's now got to be paid in this year. Again, if we assume no outstanding supplier bills, what that would mean is, in cash terms, the purchases are together £12,000. Other costs, £5,000 as before, and in cash terms, it's also 5,000. So now what we see in year 2, the cash profit is higher than it was in year 1. So our decorator will be paying taxes on the 26th. Under traditional accounting, it's only going to be the 25,000. Obviously, if there were outstanding invoices, then that will be taken into account working out the cash turnover. So if there were any outstanding invoices, that will reduce the cash amount
by whatever those invoices are. So if we said, for example, £1,000 is owing, then that would move down by 1,000 and that would become 42,000. Likewise, if there were any outstanding bills, we'd put that in and the cash payments would reduce. So folks, that's given you a snapshot, an overview of the two methods of accounting for profits. Now, cash accounting is certainly a simpler method, you could argue, but it does produce distortions on a year-by-year basis. Therefore, that means your tax could be higher in one year, lower in the next. These may not be suitable for lenders, for mortgage providers. I hope that makes some sense, folks. I'd love to hear your feedback. Give me your comments. Remember to subscribe so you can keep in touch with weekly updates. And until next week,